All right, good morning, everyone. Welcome to the Hurley Investments Trade Findings Adjustments for Thursday, the 11th of March. We are approaching the end of our first quarter. We've got a couple more weeks. We got Good Friday coming up in 3 weeks. Options expiration for the monthlies next week. A lot of our options expiration for the March 26 option series that we've been in is 2 weeks away. I'm just going to give you some information, and I'm going to point a couple things out to you on where I'm at and what I'm looking at. First of all, let's talk about SPACs. This is an old article from October of last year. There was another article that I found through Bloomberg that I just couldn't get out to everyone, but basically, I want you to understand what SPACs are now that they're, God, 200 billion part of our market, right? A SPAC is it's a licensed stock position for a company that has not yet been created that will be bought out or that will buy out a company to take it over and run it and manage it better than what they think their current management will be. So there's the short answer. As of right now, there are hundreds of billion dollars in the stock market because there's been a lot of money sitting on the sidelines. If you ever wonder about what Hurley Investments is doing for you, and you've heard me say in the past, you never miss an update in the market, there are trillions of dollars that since 2008, which is what, 13 years ago, there are trillions of dollars that have been sitting on the sidelines. A lot of people have said, well, we've got to put this money to work. You've been in it to work. The problem is some of these things that are being created like a SPAC, people don't understand. People like Graham and Dodd don't dislike Warren Buffett because you can't value a SPAC on traditional metrics. It has no earnings. It has no price to book ratios. It actually has no fundamentals in it. It's why primarily these type of positions have been called open checks. People put their money in, and the comment has been made in the past, well, if you put $10 and buy, $10,000 worth of this $10 SPAC stock ownership, if in 2 to 3 years they don't use the money for anything, you get your money back. Out of just traditional thinking, does that sound correct? Does it sound like if you put $10 and buy 10,000 shares, so $10 on 1,000 shares, that you're going to get your money back if they don't use it? Has that been your experience with Wall Street? I can't say what was just printed there, but I'll paraphrase it. Yeah, of course the answer is hell no, right? And the reason is why. Why would you not get that back? Perfect. Fees. They're going to charge you fees for your money that's been sitting there. Technically, you're supposed to get your $10 back per share that they didn't use minus fees. So when you get $7 back, don't be surprised. When you're talking about gambling, SPACs are the ultimate gamble in the stock market. Hey, I hope some billionaire buys out some company that will make me, 100% return, if not more. Make sure you read this article. They pick on Warren Buffett, right? He's getting old. He's losing a step. There's a paradigm shift. There's a reason for these nonsensical prices that what you pay $10 for is now trading at 40 with zero fundamentals behind it, right? It's gambling. If you don't have fundamentals behind it, you're gambling. If you go to Investopedia, right, a SPAC is a company with no commercial operations that is formed strictly to raise capital through an initial public offering for the purpose of acquiring an existing company. Your SPAC is going to run a company better than it's being run before. Blank check companies have been around for decades. Here is the catch from this individual. And this is what you seem to forget. SPACs are dangerous investment vehicles. Why? Well, it's one billionaire going against another billionaire. It's so unregulated that anytime you hear the word TAM or TAM, right? It's a TAM investment. What does that mean? It's best probably said this way. An analyst relying on TAM is eager to point out that a growing company in a growing industry has more to recommend than a growing company in a shrinking industry. So all they're trying to say, or to put that in plain English, I read that from right here, is that these companies have huge opportunities, but no one has any idea what those opportunities are. I found an article about 5 dangerous bubble stocks that relate to TAMs. Plain and simple, there are plenty of stocks right now that are overvalued in certain areas. Some of those overvaluations, if you look at the points here, digital currency will replace the US dollar as a denomination currency. It could, but I don't see it. Electric vehicles will eliminate gas powered, right? We're going to go green. Well, ask Houston how well that worked out. And let's face it, we don't have the infrastructure. We don't have a power station every 25 to 50 miles. Well, they can go 400 miles. Well, so can cars. But we don't pay attention till they're down to their last 50 to 25 miles of travel is when we go recharge them and everything. People are too lazy to plan out their trips each day. It's just get in a car and go. Electrical vehicles will not replace gas-powered vehicles in at least the next 20 years because the infrastructure is not there. It's all numbers. Marijuana will displace a large portion of modern medicine. Marijuana will replace alcohol, tobacco as a recreational drug of choice. Again, it could, but it's not something in the near future. Space travel will become the new logistics platform. Space tourism will displace beach vacations. God, I hope so. Send people to space so I can spend more time with what I love down here. Home sharing will replace the hotel industry. Not anytime soon. I'll be honest with you, it's pretty nice having a whole home. But let's face it, there are not enough people in the world that own second homes for having homes available. I'm actually having to buy 2 hotel rooms for my spring break trip with my family out in Houston. There aren't enough homes to take care of everyone that's out on vacation. Ride sharing will eliminate the need for personal vehicles. Yeah, right. Autonomous driving will replace human drivers. Yeah, right. Here's the funny one. Plant-based meat will replace animal meat. I've got about 260 cattle and a contract with Smiths that says that's not happening anytime soon, at least for the next 5 years, right? Food delivery will fundamentally alter consumption patterns. Gyms, calisthenics, and merely going for a jog will be replaced by digital workout platforms. Video conferencing will replace in-person meetings. I don't see it. It's all logic. In fact, if you were to ask me, these are a great example of why we all go to movies, because there's just enough truth in it to say, well, yeah, it could happen. But let's face it, who's really living a movie, a movie life, right? Yeah, it's just possible. That's why we read books. Cussler comes up with just enough probability that, yeah, it could be probable, but it's really not possible. What are the 5 stocks that this author pointed out that he's saying don't get stuck holding the bag? It's kind of funny he uses Amazon in here, but the reality is DoorDash, Zoom Video, I don't know this Alfie or Trele, Airbnb, and Uber Technologies. These are the ones that are so overvalued right now that they just don't make sense. Please feel free to read through these so that you can see his explanation where they're overvalued. He did a great job of putting in here the numbers. The numbers make sense to me. It really is an interesting read where if you can't fundamentally justify your company, maybe you shouldn't be in it. So just read through. I think you'll like it. Commentary. Stock trades take days to settle. Unnecessary risk results. A 3-day delay creates potential for systematic failures that become visible in the recent stock trading saga. And we're talking about GameStop. In all honesty, this also goes back to your options. A lot of us just let options expire over the weekend. But some of us found out through Tesla that the brokerage house is not your friend. You can literally have a bull put expire in the money. A bull put is a long put with a short put up above it. The idea behind the trade is you get a credit, you get paid to play. There's one of the most amateurish comments ever, right? You're getting paid to play. You have the right to sell a stock, protecting you from it falling too far, but you're obligated to buy it at a higher price. And the thought price is, the stock's going to keep going higher, so no one's going to sell you their stock at 120 if the stock's trading up at 130. The problem is that short option might take a day or two to settle. Meaning, if you let it expire worthless, Tesla falls $60 because of something stupid Elon Musk said after hours on Friday, your long put protection that gives you the right to sell the stock just $10 below where you might be obligated to buy it, that basically expires. And then you're assigned the stock that now has lost $60 through the weekend, and when you come to your account on Monday, you're in trouble. This article is the explanation of why GameStop and Robinhood's running into so many problems, why it's always best, even if it costs you a little bit of money, to close out those option spreads instead of just letting them expire worthless. If you're in an option spread, understand your long side, which is usually your protection against a short, can expire. Your short can last or meander through Friday, Saturday, Sunday. You could be assigned those first thing Monday morning and be in a world of hurt. I found that article on Dave Tepper. Pretty interesting about interest rates, why he's bullish. I talked about it on Monday. Here is the actual article. If we were to take a peek at where we're sitting at, we're looking at a run in our market. Apple's doing good. It might be time for some of us to do a little dollar cost averaging on Apple. As I'm looking at this account, market value 30,000. I've got a lot of cash. Apple's only $1,300. 690 over 12. It's pretty close. I might decide to adjust this one, and I'm just going to nibble because I'm expecting a couple weeks up. I'm going to nibble, and I'm going to go ahead. I'm going to get one more contract in Apple. So I'm now going to be sitting in about a $2,000, $2,200 position. See if that gets filled here today. My Boeing calls doing really well. What I paid $50.80 for is now worth $63. I'll probably set an order to get out at 100% return on these ones. That's where I'm looking to be. I want the 100% return. Baidu, I've got my 350, 450 vertical. I paid $27 for it. It's now worth 18. I overpaid. I have too much into this one. This is one that probably on the next down day would be a good one for me to do a little dollar cost averaging there. The short answer is I want to get down to about $13.50, $14 for me to do that. I've got a Disney call, a stock, I've got a stock replacement strategy, a leap long call on Disney. Paid $36.24. It's now slightly profitable. It'll be more profitable down the road. This is really one where you need to stand to your convictions. Be a little cash heavy in your portfolio and let things go. GE, I could have sold off these at $1 higher, almost 95 cents higher last week. I'm in it for the long run. I'm in it for 100% return. Could I have sold at 340? I could have, but we're staying in it for a while. Nice to see General Motors running. It should do pretty well throughout the summer. That's why I'm in this position. We're going to see where it runs through summer. In June, it ends up having out a bunch of these 12 new electrical vehicles that are out there. Very interesting to see where it goes. Under Armour, there's a good chance I'm going to get called away from Under Armour, possibly. I've got to get through next week, but I've taken 75 cents of credit. I'm just going to do a covered call strategy in Under Armour since it doesn't have its earnings until I think May 10th. May 10th is its earnings down here. I've got some time for Under Armour to make a run. My thought process behind Under Armour is, hey, it's taking advantage of the newer regime change we have in the U.S., where now Under Armour can use its Asia material, its Asia plants, manufacturing, and now can take advantage of what it has out in Asia. It'll be good to see that happen. Looks like I got filled on my Apple call. So I like where I'm at on Under Armour. If I have my short call expire worthless in March, I will sell another one at $25 for April. And hopefully I'm doing that closer to $23.80 than I am at $23 period. And then I've got my Visa calls in here. I like where Visa is sitting at. If someone were to ask me, what am I missing? I do have Under Armour for retail, but I'm missing retail in here. I'm also missing banks in here right now. Kevin, why aren't you doing more banks? Why isn't this one since the beginning of the year? Why aren't you in Bank of America? Well, banks haven't fared very well with stimulus. So in all honesty, I'm looking to get into banks, especially something like Bank of America, pre-August. I'll get into it in July. In August, you can see Bank of America move somewhere between 20 to 35%. That's my timing for Bank of America. I really would like to get into something like Costco that I can see I'm not in right now. If I was looking at a position, something that I'd like to be in, I'd be looking at Costco today. It's been beaten up. If I can bring up a chart for it, it's been beaten up. It has really kind of been ugly. Let's go out to a month. Let's go out to 3 months. 380 down to as low as 307. It's sitting right at 329 today. Kevin, why would you get in today at 329, 330? Well, because you can get to 380. That's why. Shouldn't you do some more technical analysis on it, right? Well, let's do it. Let's take a look at Costco. Has quite a ways to run higher. Has 340 as its 200-day moving average. So I've got about $10 of movement there before I can expect to stop. If we were to also go ahead and let's go to FinViz. We're looking at the Costco chart here. It's telling me 350. I do have the 341 200-day. 350 would be more of a run up. We have that opportunity. I think I'm going to take it. I think if I was looking to put a new position in, I would do it now during the lunch hour. I would try to get a great price for it, but I would be looking at finding an option, a stock replacement strategy on Costco. I want to go out to January 23, so I've got a lot of time. If it's at 330, I probably would look at a 350. And I probably would be cheap. I'm not going to do 10. My account portfolio here would not value it. But yeah, I mean, let's go down to 35.50, 35.40. Let's find a position for $3,500 to take advantage of a rebound on Costco. And I'll let that one sit for today. Just because it didn't give guidance and it was smart, not pushing its guidance, I think it's in a good position. So if I was looking for a trade today, it's going to be a Costco leap, $35. It's $3,500. I'm giving myself 1 year, 9 months for it to move up a little bit. I like where it would be at. I'm going to get a good price at $35.50. That's what I'm looking to do. Any questions in general about positions in accounts, or any questions you guys like to have me answer for you in regards to what we're doing and why, or what we see in our markets and why? Guys, be safe out there, be smart, and I look forward to seeing you Monday night.